Let's look at the Kenyan markets now and see what's been happening or how, on that market, which for the past 2 days has been under pressure, and that pressure certainly continuing today. The market down 1.2%, 4,774 out on the currency front. The Kenyan shilling, like all other emerging currencies, slightly up against the dollar today, 1/3%, 85.40 at the moment. Let's now join from our studios in Nairobi for the Kenyan market, George Bodo, Head of Financials Desk at Ecobank. George, thanks for your time this afternoon. As I said in my intro, that market continuing under pressure, and for a third straight day, we've got the market down. I would read that people are just really treading water here ahead of the finalization of those results around the presidential election. Would you agree?
I think generally the market valuations have been retreating over the past 3 days, and it's very simple. A lot of pullbacks in the market, because what we saw last week was a significant rallying of the market that was quite unsustainable. I think the valuations rose as much as 5% in a very short span of time, and that was obviously not quite sustainable. At some point, valuations were bound to collapse, and that's exactly what you're seeing here. There are a lot of pullbacks in the market.
Absolutely. What I got, I think, in the first 2 days of the week, that is Monday as well as Tuesday, was a gain of 7%. While we are still holding up in terms of positive gains since the week began, certainly we are making serious inroads into the percentage gain for the week here.
Certainly. But I think on an individual basis, some of those stocks have wiped out significant value in excess of 10%. Since on a week-to-date basis. And obviously the most significant side of the market is the banking sector. The valuations, although on a week-to-date basis are a bit down, but on a year-to-date basis, for instance, the average price index for the banking sector is still up 24%. So we are not doing that badly. I think this was a short-term secondary correction that was actually was in the offing anyway,
Given the huge jump that we saw. Let's stick within the banking sector. And today we're Standard Chartered Bank posting a 38% rise in net profit, and at the same time boosting that dividend to 12.50 Kenyan shillings. Is this a stock that you would accumulate given the results that we've been seeing coming out of them of late?
I think given it's certainly a very interesting point there. But if you look at a bigger picture, I think banks primarily generally, on a general basis, Q4 numbers have not been that good. The quality of the Q4 earnings have not been that good generally. And I think even in Standard alone, if you look at it, if you look at the Q4 numbers, I think net earnings per share was down 13% quarter on quarter, and just shows that for the last quarter of the year, banks were really struggling. On an industry aggregate basis, the sector's profit before tax was down 3%. And an interesting observation that we had we've just seen today is the fact that while the industry aggregate PBT was down 3%, actually the listed banks PBT was up 10%, and we're really struggling to assign a reason to that. But just to get back to your point, is the fact that the banking sector, despite posting negative returns on a quarter-on-quarter basis for Q4, I think on a cumulative basis in your year, you look at growth rates above 20%. So that still puts banking sector in Kenya as a sector to watch in the market.
Absolutely, particularly given the fact that we do know that there may be, as the year progresses, perhaps a further decline in the benchmark rate by the central bank, even though they left it unchanged at the last sitting. But I just wanted to quickly talk about the results from Diamond Trust Bank as well. Here we had a 36.6% increase in net profit for the year, and that was on the back of a high interest income as well as improved performance from its subsidiaries. What would you say about Diamond Trust Bank?
I think Diamond Trust Bank posted quite a very resilient results. In fact, even if you put aside the year-on-year analysis, if you look at the Q4, net earnings was up 30% on a quarter-on-quarter basis, which was quite impressive and driven by the fact that the bank was able to sweat its assets and the fact that the cross-sellability, the ratio of core interest income to non-core interest income was quite close, and I think both business lines were quite stable and very healthy. It just also shows that the bank's business pipeline was very healthy, has been healthy for the whole of the year. The second point is the fact that the bank was able to control its cost of funds, because you realize that banks' primary role is to create shareholder value from the liability side. You know, it's a question of trying to balance the cost of funds and the cost of lending. I think if you look at Diamond Star compared to last year, they were able to actually contain the cost of funds to below 5%, which was quite impressive for that bank. You know, so I think for Diamond Trust Bank is another stock to watch, given its operational excellence. You know.
Yeah, so let's go back to my point about the outlook for interest rates, given the fact that we're the central bank earlier this week holding steady its benchmark rate at 9.5%. What's your forecast? Are we likely to see a lower trend in interest rates for the rest of the year, and therefore, as I would imagine, perhaps a re-rating of the banking sector?
I think generally the banking sector, despite what happens, it will be very stable. Before I get into my forecast for the rates for this year, I think I just want to say that we still forecast loan book growth in the region of between 15 to 20%. Last year they did 15%, which is still within central bank's target of 16%. I think this year the central bank is still having a sub 20% target. That if the private sector credit growth and the loan book growth is between 20% is under 20%, then we will see a very mild the current interest rate regime, and I think we don't see we do not see a growth rate, loan book growth rate of 20% year on year. So on that front, we still see a very mild interest rate environment this year, sub 10% where we are.
Yeah.
You know.
What about the new central bank's prudential guidelines and around capital issuance as well? What kind of an impact do you potentially see this having on earnings, as well as, of course, the bank's ability to be able to grow their loan books?
I think generally I still have an axe to grind with the new regime that was issued for January 2013. There's been no much change in certain key aspects of regulation. I think there was no major shake-up to such aspects like obligor risk rating, the credit risk rating structure, the core capital regulation, core capital environment. They were still held at the same rate. However, the only new aspect that is likely to bring about exert some capital pressures on the local banks is the fact that the central bank has introduced a new aspect that they call capital conservation buffer, which is pegged at 2.5% of total risk-weighted asset. I think this is bound to exert a little bit of capital pressures on the current capital adequacy regime. But however, I think if you look at the current strength of the capital strength of the market, it's quite strong, and I think banks will not have to resort to capital raising or selling new shares to raise capital. I think they probably more resort to stuff like selling non-core assets or reducing the dividend payout ratio. I think they can easily meet it. But on a general basis, I think it was the policy makers that are trying to strike a balance between economic growth that is advanced by lending and also the cash that banks hold. So they didn't want to let banks hold so much cash that they don't lend out, because they're also concerned about economic growth.